Silver at $89.51. The Geneva Catalyst and what the data is screaming. Silver just closed up 4.5% today, $89.51 per ounce. Mainstream financial media is labeling it a safe haven rally. They're giving you half the picture. The real story isn't the 4.5% advance that already occurred. The real story is what's scheduled to unfold in the next 24 hours that could ignite something far more significant. Tomorrow, Thursday, February 26th, the United States and Iran convene in Geneva for a third round of nuclear negotiations. The president has publicly imposed a 10 to 15-day deadline for Iran to finalize an agreement. The largest American military concentration in the Middle East since 2003 is stationed offshore right now. 2 aircraft carrier strike groups, the USS Gerald R. Ford and the USS Abraham Lincoln, hundreds of service members repositioned from Al Udeid Air Base. Air defense systems deployed across Iraq, Syria, Kuwait, Jordan, and the UAE. That is not a negotiation posture. That is a war footing. And silver historically responds to military escalation with greater volatility than gold. More beta, more intensity in both directions. That's not opinion. That's decades of price data. What transpires in Geneva tomorrow is a binary catalyst. Either diplomacy prevails and silver retreats short-term, or talks disintegrate and the geopolitical risk premium surges overnight while most Western traders are asleep. That's why tonight matters. That's why you need to comprehend exactly what's happening in this market before making any decision. Let me be perfectly transparent before we go further. This is not financial guidance. I don't manage capital. I don't sell programs. I don't operate paid communities. If anyone reaches out using this channel's name requesting money, it's a scam. Block them. Report them immediately. What I do here is dissect data, publicly available, verifiable, source checkable data. I present it. You reach your own conclusions. Now let's examine the numbers, because today's numbers are extraordinary. Silver spot price, as I'm recording, $89.51, up 4.45% on the session. Gold sitting at 5,182. The gold to silver ratio currently stands at 57.9. That figure is significant. Over the past decade, the average ratio has hovered around 80 to 1. During previous bull market peaks, it compressed all the way down to 15 to 1 and 30 to 1. If the ratio merely tightens to 30 to 1 at current gold prices, that places silver above $170 per ounce. That isn't some far-fetched projection from an obscure blog. That's elementary arithmetic using the present gold price and a historically documented ratio. You can compute it yourself right now. But the price on your screen is only one element of this puzzle. Let me reveal what's occurring beneath the surface that almost nobody is reporting. COMEX registered silver inventory has dropped below 90 million ounces. 88 at 191,000 ounces to be exact. That's the silver actually warranted and accessible for delivery against futures contracts. Not the total vault figure, not the eligible category where metal is privately held, and not committed for delivery. The registered category, the metal that underpins the commitments being made in the futures market. In October 2025, that figure stood at approximately 130 million ounces. It has plunged 32% in 4 months. Total COMEX silver inventory, registered plus eligible combined, has fallen from 532 million ounces in October to 366 million ounces today. That's a 31% decline across all categories. 366 million ounces sounds substantial until you examine the other side of the ledger. March 2026 is a major delivery month. Open interest on March silver contracts represents approximately 230 million ounces of paper silver claims against 88 million ounces of registered deliverable metal. That's a ratio exceeding 2.6 paper claims for every single physical ounce available for delivery. Some independent analysts tracking total open interest across all contract months estimate the broader ratio at 4 to 5 paper claims per physical ounce. If even 25% of March contract holders elect to stand for delivery, demanding actual metal rather than cash settlement, the exchange confronts a mathematical problem it cannot resolve with existing inventory. This isn't conjecture. This is division. Retrieve the COMEX warehouse stock reports yourself. They're refreshed daily. They're public. The figures don't deceive, even when the commentary surrounding them does. Here's a data point that should make you pause mid-scroll. In a single 7-day stretch recently, 33 million ounces of silver were pulled from COMEX registered inventory. 33 million ounces, that was 26% of the entire registered category at the time, vanished in 1 week. When withdrawals occur at that velocity against a backdrop of inventory already at multi-month lows, you're not observing normal market activity. You're observing structural strain. Now let me transport you to the other side of the globe, where silver's price tells an entirely different story than what COMEX displays. Shanghai silver is trading at more than $10 per ounce above the COMEX price. Not 10 cents, not $1, 10 plus. In some sessions during January's crash, the premium swelled even further. Paper silver on COMEX crashed to around $74, while physical silver on the Shanghai Gold Exchange commanded premiums exceeding 54% above that paper price. Let that register. The paper market declared silver was worth $74. The physical market in China declared it was worth over $90 at the same moment. Two prices for the same metal on the same planet. The Shanghai Gold Exchange mandates 100% physical delivery. No paper settlement, no cash alternatives. When buyers on that exchange place an order, actual metal must change hands. That premium is the market communicating in real time that physical silver carries substantially more value than the paper price generated in New York. And that premium has endured for months. It's not a glitch. It's not a fleeting dislocation. It's a structural rift between paper pricing and physical reality. Silver lease rates corroborate this tightness. Lease rates spiked to approximately 8% annualized during recent stress periods. Normal lease rates range between 0.3% and 0.5%. An 8% lease rate means holders of physical silver are extracting a massive premium to lend their metal because they recognize how scarce it is. When merely borrowing silver temporarily costs that much, the underlying physical market is under severe pressure. Verify silver lease rate data through publicly available London market reports. This is trackable. This is documented. Now, let me link the geopolitical picture to the supply picture, because these aren't separate narratives. They're the same narrative. On February 20th, 5 days ago, the United States Supreme Court issued a 6-3 ruling in Learning Resources Incorporated versus Trump. The court invalidated the Liberation Day reciprocal tariffs that had been in force since early 2025. The ruling determined that the International Emergency Economic Powers Act does not empower the president to impose broad-based tariffs. That created a 48-hour vacuum of uncertainty. Markets lurched. Within 2 days, a new executive order was signed invoking Section 122 of the Trade Act of 1974. A temporary 10% global surcharge was imposed, then raised to 15%, the statutory ceiling. That 15% global tariff officially took effect Tuesday, February 24th. Yesterday, 1 day before silver surged, or put to 4.5%. Coincidence is not an analytical methodology. The new tariff regime constricts supply chains for silver-intensive industrial components entering the U.S. market. It elevates manufacturing costs. It reintroduces inflationary pressure that channels safe haven demand directly into precious metals. And it signals globally that trade barriers aren't disappearing. They're being reconstructed on different legal foundations. But the tariff story isn't even the most consequential policy development for silver right now. Here's what is. The United States government has officially reclassified silver as a critical mineral and strategic national resource. This occurred through an expansion of Executive Order 1938 and a comprehensive Section 232 investigation into processed mineral imports. Silver is no longer categorized as a discretionary precious metal. It's now recognized as indispensable to America's 5G infrastructure, AI data centers, satellite communications, military systems, and the 16 critical infrastructure sectors identified under National Security Memorandum 22. On February 2nd, the administration announced Project Vault. The Export-Import Bank of the United States approved a direct loan of up to $10 billion, the largest in the bank's history, to establish a domestic strategic reserve for critical minerals, including silver. $10 billion for strategic mineral stockpiling. When a government begins acquiring physical metal for national security reserves, that metal exits the open market. It doesn't return. It generates permanent demand that doesn't respond to price signals the way speculative demand does. The government doesn't liquidate its strategic reserves because the price dipped 10%. It retains them because national security isn't a trade. The United States has also launched the Forum on Resource Geostrategic Engagement, known as FORGE, to construct diversified supply chains with allied partners, specifically targeting reduced dependence on Chinese silver processing. The policy architecture being erected around silver right now isn't temporary. It's structural. It's generational. It fundamentally reshapes the supply-demand equation that has governed this market for decades. Let me address the January crash directly, because if you were in this market, you experienced it. On January 30th, silver plummeted more than 35% in a single day, from nearly $130 down to the mid-80s. It was the steepest single-day percentage decline in modern silver market history. The CME Group raised margin requirements from 11% to 15%. That 4-point increase compelled leveraged traders to either inject substantial capital immediately or face liquidation. Most were liquidated. The forced selling cascaded, algorithms triggered, stop losses fired. The crash coincided with the nomination of Kevin Warsh as the next Federal Reserve Chair. Warsh's hawkish reputation sparked a massive rotation out of commodities into U.S. Treasuries. The dollar strengthened. Dollar-denominated silver was squeezed from both flanks. Here's what's essential to understand about that crash. Physical premiums surged during the paper price collapse. While futures showed silver at $74, physical silver in Shanghai commanded premiums of $20 or more above that figure. The paper market and the physical market moved in opposing directions simultaneously. That doesn't occur in a healthy, properly functioning market. That occurs when paper derivatives are being deployed to force price in a direction that physical supply and demand don't support. Since that crash, silver has recovered 35% in under a month. That recovery velocity reveals something about whether the crash represented genuine price discovery or temporary mechanical dislocation caused by margin manipulation and forced liquidation. The recovery argues compellingly for the latter. Silver isn't merely money. It's the most electrically and thermally conductive element on Earth. Solar panels, electric vehicles, AI data centers, 5G base stations, military electronics, satellite systems, all require silver. The solar sector has been the largest industrial consumer, but rising costs are driving substitution. Silver paste now constitutes 17 to 29% of total photovoltaic module cost, up from 3% in 2023. Chinese solar manufacturers are accelerating copper substitution. PV silver demand is projected to decline 7% year over year to 194 million ounces in 2026. But here's the counterbalance that's receiving insufficient attention. AI infrastructure demand is surging to fill that void and potentially surpass it. AI data centers require silver's peak conductivity for high-performance computing environments. You cannot swap in copper for applications where thermal management at the chip level determines whether a $100 million server farm operates or overheats. The Silver Institute projects that growth in AI technologies, data centers, and automotive electronics will sustain a structural market deficit for the 6th consecutive year. 6 years of deficit. 6 years where industrial and investment demand has outstripped mining supply and recycling combined. And this is happening while COMEX vaults are draining and governments are stockpiling. Let me present the bearish argument because you deserve candor, not cheerleading. The January crash demonstrated that silver can shed 35% in a single session. Margin increases can arrive without warning, and leveraged positions are exposed. The Section 122 tariff surcharge is capped at 150 days unless Congress extends it. If tariffs lapse, one pillar of the safe haven thesis weakens. Recycling supply is forecast to grow 7% to over 200 million ounces in 2026 as elevated prices incentivize scrap flows. Solar substitution toward copper is real and gaining momentum. And paper market manipulation, as documented in JP Morgan's $920 million settlement, can persist for years, sometimes decades. Anyone claiming silver can only appreciate is either uninformed or marketing something. The trajectory higher isn't a straight line. It never has been. Corrections will be severe. Volatility will challenge your conviction. But here's what the bearish case cannot resolve. Where does the physical metal originate? You can generate paper contracts. You can create derivatives. You can synthetically short silver to whatever degree regulators allow. But you cannot manufacture physical metal. And when registered COMEX inventory sits at 88 million ounces against hundreds of millions in paper claims, when Shanghai buyers pay $10 per ounce more than New York's paper price, when lease rates reach 8%, when a government begins constructing strategic reserves backed by a $10 billion credit facility, the physical market is transmitting a signal that paper markets cannot suppress indefinitely. Monitor Geneva tomorrow. Monitor the March delivery data as it develops. Monitor COMEX registered inventory daily. Monitor the Shanghai premium. These are the data points that will indicate whether the physical paper divergence is accelerating or stabilizing. Don't rely on financial television for this. Don't await mainstream validation. By the time they cover this story in comfortable terms, the move will have already transpired. Retrieve the COMEX warehouse reports. Check the Shanghai Gold Exchange spot prices. Read the Supreme Court ruling in Learning Resources versus Trump. Examine the Ex-Im Bank Project Vault announcement. Review the Silver Institute's 2026 deficit projection. Every single data point I've cited in this video is publicly available, independently verifiable, and source checkable. If this analysis provided something you didn't receive from mainstream coverage, leave a comment. Let me know you're here. Let me know you're paying attention, because the data is accessible to everyone. The difference is who actually examines it and who waits to be told what it means after the move has already occurred. Verify everything. Trust data over narrative, and understand that the most consequential moves in this market happen when most people aren't watching.